So the largest part of your core holding or your growth holding should be broad, inexpensive index funds. Now, let's talk about fees for a moment and how this works. If you pay an advisor to help you pick mutual funds, most of the time, not all the time, but most of the time, that advisor is going to have a handful of fund families that they're comfortable with and they're familiar with. Very popular fund families are American Funds, Franklin Templeton, Dodge and Cox. There are lots of very good fund families. They have different kinds of funds that have a little bit of this, a little bit of that, more large, more small, whatever. Most of the time, those funds are charging anywhere between 0.7% to 1%. 1% equals 100 basis points. That's the way to measure the fees that these funds charge you. Now, this is not money that you are paying your advisor. This is money that's getting deducted from the funds that you invest in, and that goes to pay the money managers of those funds. Now, what are those managers doing? Number one, they're picking stocks. Number two, they're trying to limit some of the downside volatility. But here's the reality. If the market is up 15%, your actively managed fund is going to be up somewhere between 13.5 and 16%. They might beat the market a little bit. They might trail it a little bit. Over time, very few active fund managers beat the indexes. They just don't. This is statistical. It's been studied time and time again. If they are in the business of picking stocks and trying to beat the indexes, it's very hard to do. Most fund company managers simply just try to capture the market and they try to limit volatility. When I was a retail advisor, the funds that I use, typically I would tell clients, you're not going to get the full market return, but you're also not going to go down as much in a bad year. And that's basically what advisors, that's the message on why they justify doing it this way. Okay. But I would argue, instead of paying that 0.7 to 1% to some fund manager to manage your money, why not pay 3 basis points? Okay. 5 basis points instead of 70 to 100 basis points to Vanguard or to another very low cost index fund. You're basically getting the return of the market and you're paying almost nothing in management fees. These type funds aren't trying to pick stocks. They're just buying the whole index. So whatever the S&P does, that's what your fund does. It's an index fund. It just follows the index. But there's nobody making decisions, buying or selling anything. So they're unbelievably cheap. The expenses are low. That's what we're looking for to build that core portfolio. Now, there are lots and lots of different index funds that have very low expense ratios for small caps, mid caps, international real estate, basically everything you can imagine. But there's nobody deciding what to buy and sell inside these funds. They're just covering an index. They're just buying everything. That's what we want because we want to keep fees low. Okay. So that's the core part is don't pay a bunch of active managers, build the portfolio with very low cost index funds and tailor it the way we want, but keep the fees low. So the next part that I want to talk about is options. And again, a lot of investors are afraid of options. Options can be very dangerous to someone who is overconfident and don't understand what they're doing. But the simplest way to understand one option strategy that I use is it's called buying a put option. Okay. A put option is nothing more than an insurance policy. So let's flip the switch and move away from the stock market for a minute. Let's talk about real estate. So let's say you buy a house, and I'm just going to make up round numbers. Let's say you buy a house for $500,000 and that's the value of your house. What if a tree falls on it? What if a fire totally burns the house down? You have insurance to cover it. So what does that actually look like? What is insurance if we had to define it? I am paying the insurance company an amount, a premium, and basically the insurance company is saying, okay, no matter what, I will buy that house from you for X amount of price for a certain amount of time as long as you make your premium payment. And you say, okay, that's a good deal. So do you want to fully insure your house? You could. If your house is worth $500,000, you could say, I want you to pay me $500,000 if the house burns down. Or you could have a deductible, which is I want to, if the house burns down, you're going to give me 475,000 for the house. That's a $25,000 cut that I have to make. The reason insurance companies do that is because true risk mitigating insurance can't be structured for profit, because then it would incentivize somebody to use it. So the law is that there has to be there has to be a loss. Okay, the financial markets, it's not that way necessarily, but to summarize, basically, if you pay your premium to the insurance company is covering your downside risk against loss. Okay. You can do that in the financial market at any time with most every stock and most every index. So let's think about it in terms of what it would look like in your portfolio. Let's say you have $1 million of a certain investment. And for easy purposes, let's just say it's an ETF, or that an ETF is an exchange traded fund. So it's basically a fund of the S&P 500, and you own $1 million of that. You could come and say, for 3 months, I want to guarantee that I'm not going to lose a penny on that $1 million that my S&P 500 fund is worth. And I have to pay a premium for that 3 months of protection. And you would buy a put option that would cover you. That's easily done. People do it all the time in the markets. Now, is that wise? Not in that scenario, no, because it's too expensive. It's very expensive to fully insure your portfolio. Okay. But you can tailor this any way you want. So let's say of my million, I want to cap my loss to 10%. So no matter what, within the next 3 months, if the world blew up and the market went down 80%, I want to be able to get 900,000 out of my investment. You could buy a 3-month put option that would give you that to make sure it was worth 900,000 no matter what happened. It's still expensive, but it's not quite as unreasonable as fully insuring. So an individual stock, a index, you can insure it at any time. And that's one of the most important legs in our portfolio framework that we need, is that we need to have protection. Another word for this type of protection is a hedge, hence the term hedge fund. This is what hedge funds do. They use options to basically protect the value of their portfolios. Now, it's a huge difference when you have a couple $1 million that you're doing this with, and you have $50 billion in a hedge fund. The liquidity and the actual mechanics of how you would go about doing it is a different thing. But on an individual level, using options, it's very straightforward to protect your portfolio. Why don't more people do this? To be honest, it's not that hard, but most financial advisors are relationship managers. They farm out the money management to other fund managers. There are funds that do this, but most of the time they charge exorbitant fees, and it's quite expensive. I get advertisements of fees that are doing this sort of structured product, and sometimes the fees for the funds are as high as 3.5% to 4%. It's ridiculous how much they charge. But there is a desire, and there should be a desire, for any investor when they get to retirement age to protect their portfolio. And this is the basic way to do it, is you do it with put options, and you have to develop a system in how you're going to hedge against a sharp downside correction. So there are ways to help pay for these put options, or basically this insurance policy. The easiest way to help pay for it is to sell options that give us income that will basically pay for the downside protection of the put options. And that is typically called a covered call option. So a covered call is, let's think about it back in terms of real estate. If I have a house that's worth 500,000 and I have a speculator that maybe wants to buy my house, maybe doesn't want to buy my house, but the speculator comes to me and says, hey, I would like to offer, or I'd like the right to buy your house for $525,000 within the next 3 months, but I'm going to give you $5,000 for you to agree to that. Would you do it? Maybe not. It depends on if you wanted to move. It depends on if you were married to the house. There's lots of variables, but think about that transaction. You're getting a $25,000 premium on top of what your house is valued. Your house is valued at $500,000. If the guy bought it from you, you're making money on it. right? Compared to where it is today. And he's paying you $5,000 today as a premium that you get to put in your pocket for you to agree to sell it to him for 525. What's the downside to you? What if Amazon announces that they're going to build a distribution center 2 miles down the road, and all of a sudden overnight your house becomes worth $700,000? You've agreed by contract to sell it to this gentleman for 525. Did you lose money? Maybe not, depends on how you look at it, but you lost the upside, but you got income, the 5,000 you put in your pocket, and you also made a profit on your existing house. What happens if the Amazon thing doesn't come to fruition and the contract expires after 3 months? Now you're not obligated to sell it anymore. It's yours free and clear. Nothing happens, but you still get to keep the $5,000 that you put in your pocket at the beginning of the 3 months. That's exactly how a covered call option works. Okay. You have a stock position or an index fund position or any kind of position in your portfolio. You decide, I am going to agree to sell it at a certain price. I'm going to get paid a premium. And if it goes above that price, more than likely it's going to get called away and I'm going to have to sell it. If it stays below that price, nothing happens and I get to keep the premium. Okay. This is called covered call options. Covered calls work in non-qualified accounts, but they work magic in retirement accounts. Why? Because there's no tax implications. If you buy and sell a lot inside a retirement account, there's no cost basis to worry about. There's no capital gains. Everything is tax deferred. So inside a Roth or inside a traditional IRA, we do a lot of covered call options. Now, putting these two concepts together, let's think about what that would look like. If I have a portfolio worth $1 million and I want to protect it, I want to limit the downside risk to, let's say, 5% or 10%. I can buy put options to cover that. I do it for 3 months or 6 months or whatever time frame I decide I want to do it. That's expensive. How do I go about financing those put options? I sell covered call options. What am I actually doing by selling a covered call option? I'm limiting the upside by a certain degree, but I'm generating that income, and that income helps me pay for the protection. Okay. Now, do I want to do this to my entire portfolio? Absolutely not, because we want to have growth. We want to have investments that may 5X or 10X. That's definitely a part of it. But for another part of the portfolio, we want to have downside protection. Basically, we want to have enough protection that covers the whole portfolio, but we want to generate income using our option strategies to basically help pay for it. So when you get to retirement, this is huge because we can structure, if the market is starting to get a little dicey, we can tighten up our protection a bit and we can limit it even further. If the market's going along pretty well, we can be a little bit more lax on how much protection we need. And I like thinking of homeowner scenario, we can increase our deductible slightly so it's a little cheaper, but then we can generate income by selling the options and use that to help fund our retirement. So rather than only relying on interest-bearing stuff and dividends, which typically are in the 3 to 4% range, that's where we get the 4% rule, where people have done studies that said, I can only withdraw 4% to make sure I don't run out of money. If we're selling options and we're generating additional income in our portfolio, we could push that up to 6-7% and not miss a beat. So we use options to protect and also to generate income, but we do it to support having a very robust growth bucket in our portfolio to where we do very well when the market's doing well. So tying this back to a typical financial advisor, if you go in, you sit down and you say, I've got $1 million, I'm getting close to retirement. I don't want to take a lot of risk with this money. I want to make sure that I've got a good plan to mitigate a big market downturn. There's two options they're going to offer you. Number one, they're going to give you a big chunk of it in some sort of fixed income investment, a money market fund, a fixed annuity, CD type investment, something that's going to pay you on the order of 4 to 5%. As we've already discussed, if inflation over the last 25 years is 6.8%, if you're locking a huge chunk of your money into 4 to 4.5%, you're basically guaranteeing you're going to have negative real returns. Okay. Now, on the flip side, if they don't want to do that, they're going to introduce some sort of structured annuity product. So let's talk about those for a minute. You're going to see all kinds of stuff, but from variable annuities, which are basically a wrapper of index type funds inside a tax deferred structure. But the fees on that are typically all in, paying your advisor, everything. They're 3 to 4.5%, 5% a year. And that's a headwind. That's a drag against any performance you have. An equity linked fixed type annuity is basically a insurance product. It's not even an advice. It's not even, it doesn't even actually own the true investments inside it. But basically what they're doing is what I just described to you. Okay. They're taking your money. They're using options and derivatives to generate return scenarios based on the market. They're using puts for downside protection. They're selling options for upside, and they're keeping a huge chunk of it, and they're giving you a certain return every year. But here's the kicker, and here's the catch. It's not your money anymore. You've given all your money to the insurance company, and all they're doing is promising you an income stream. Okay. So this is the key piece about annuities that people really need to understand. If you decide you want your money back and you're not past your surrender period, they are going to absolutely murder you when you try to get your money out. Okay. If you put in, let's say you put in $500,000 into this type of annuity and something happens in 3 years and you go in and you say, look, I need $150,000 next week. It's an emergency. I'm sorry, I don't have another source that I can get it from easily. I need this money. That you're going to get killed in fees. And you can't really blame the annuity company. You can't really call them evil. They structure these products to be profitable, but the point is they are not the best way to do this. If you have an advisor who understands how to use options effectively and can walk you through it, your outcome is so much better with flexibility and much, much lower fees doing it yourself rather than handing it over to a structured product to an insurance company. So to summarize this video, we've talked about the structure and how it works to set up a portfolio using this framework with these buckets. In the next video, we're going to deep dive into put protection and give a couple concrete examples on how it works and what it looks like and how you can actually implement it.